Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Good morning, C2P, and happy Love Month. As we know, one of our favorites, Dave Buchwald, calls life insurance a love policy. So thank you for joining us. Did you know that more life insurance is sold on a Thursday before Valentine's Day than any other day of the week? Okay, now don't tell compliance that's not a real statistic, but it's a fun thing to think about. I'm excited to have our two guests on today, the Stoyan Petev. Stoyan brings a great deal of knowledge. He is our Senior Vice President of Advanced Markets, where he leads our firm's in-house life insurance platform and supports our advisors with expertise in investment sales and advanced planning. With nearly three decades, and he only looks 23 of experience, he has worked as an advisor in distribution, a research analyst, and a consultant, specializing in risk management, holistic financial planning, and product development. Welcome, Stoyan. I'm also excited to have another Pacific Northwesterner with us, Mr. Walter Young. And when he's not out there helping with insurance, he's out there running the mountains of Washington. But Walter helps professionals create tax-free retirement, leveraging the little-known fifth option that prevents them from feeling financially anxious about the future. Walter is a national speaker, and a good one at that. He has done industry panels, and he has an Amazon best-selling book called The Fifth Option and The Desert Island Dilemma. Ooh, sounds interesting. With a dynamic blend of storytelling, humor, and financial planning expertise, he educates audiences on retirement income strategies in today's complex environment. So welcome, Walter.
Good morning, everyone. Thank you.
I'm so excited to have these two here today because I can't wait to learn from two of the best. So I'm going to kick it to Stoyan first. Stoyan, you've talked before on Coffee Break and on our podcast about life insurance as an asset class. This is becoming a more popular viewpoint on how to think about life insurance in the context of a financial plan, particularly for our high net worth clients. How might advisors explain this to their clients?
As the Thursday before Valentine's Day, I gotta rush out and buy my life insurance policy when I go by your fun fact early in the podcast. But yeah, joking aside, life insurance has been utilized by high net worth and ultra high net worth people for various reasons. And probably more than anybody else, they appreciate the value that life insurance brings to the table. One of the most commonly used techniques within that community is to use life insurance owned in an irrevocable trust to pay for estate taxes after death. And I'm sure that a lot of you are familiar with the technique where the life insurance policy is owned by the trust. The trust is the beneficiary, and the client makes regular gifts to the trust to pay for the premiums. And after the client's death or the second death, the life insurance death benefit proceeds get paid into the trust, and the trust provides the liquidity to the estate to pay estate taxes and bring in things like small business interests or any particular illiquid real estate interests or any other estate assets into the trust for the next generations. And so that's probably one of the most widely used techniques. It's been very well documented throughout the industry, and we're pretty well versed into that particular strategy. Now, the ones that not a lot of people talk about are the estate equalization techniques that are used by high net worth and ultra high net worth individuals. And whether it's going to be a business owner or a farmer, if you have a closely held family business, and if not all of your children want to go back into the business and continue to develop that business, if they don't have a particular interest in that sphere, they basically the family can use a life insurance policy to equalize the estate to those kids that leave the family and pursue their own interests. So in a technique like that, The business goes to the kids or the next generation that wants to stay involved. And then the life insurance policy provides an equitable cash benefit in the estate to the kids that leave the business and pursue their own interests. Another very big area where life insurance comes into play in the ultra high net worth space is premium financing. And we haven't talked about a lot about that particular topic, but high net worth and ultra high net worth individuals, they know the value of using other people's money to benefit them. And for example, I used to work with a decent amount of real estate developers down in Texas. And what they valued the most was that while their properties were generating a cash yield of 20 to 25% per year, their real estate investments, they still needed life insurance. Their families needed life insurance. Their business partners needed life insurance in a buy-sell setting. They utilized a ton of premium financing strategies to basically go to the bank, borrow money for life insurance premium, and put the policy as a collateral, and then use a small chunk of their assets in their real estate empires or business empires to round out the collateral. And for a yield or borrowing rate much lower than their return on capital in their businesses, they were able to get the much needed life insurance protection for their estate taxes, for their business partners, to buy out their partners from the business in a buy-sell setting, or for various other reasons that we can mention at a later discussion. But that's another big use of life insurance. Also, what I have seen a lot of people do in that space is using the life insurance to basically replenish the estate if you set up a charitable remainder trust. And I know that we have talked about charitable remainder trusts as part of our tax management journey here at C2P, and the training that Dave Allison has put forward along with Chris Worley. And for those of you that haven't attended that training, it is very beneficial for your practice and for the conversations that you have with your clients. But in those types of settings where you put a significantly appreciated asset into a charitable remainder trust, utilizing life insurance to bring back that asset into the estate and for the next generation for pennies on the dollar is a very good technique.
Always good information from Stoyan. And Stoyan and Eric and I joke all the time that we can talk about this stuff ad nauseum and not stop. But I'm going to pitch the ball over to Walter, because I'm at that age, Walter, where I sit down with my friends and we talk about our financials. We talk about retirement. We talk about life insurance, and they all think I'm crazy. They're like, why do I need life insurance? It's a death benefit. So since many clients do associate life insurance with just a death benefit, how can advisors discuss with their clients how certain life insurance policies can provide living benefits and income sources, as well as advantages once they have it in place?
That's a great question. And we'll take it from the ultra high net worth now to the living room, or the living room table, where we could talk with kind of the average person about where life insurance fits with them. And so one of the things I like to help explain to clients is, one of the things I like to do is I want to know how many benefits each dollar gets when I put it into certain accounts. And what I mean by that is, for example, if I put money into a 401k, I get about 5 benefits from that, right? Might get a match from the employer. I get to defer some income. There's potential growth that happens in the 401k. Then there is some asset protection because of the 401k. And then ultimately it can be passed on to a beneficiary. So I get 5 benefits for that single dollar. Real estate has another 4 or 5 options as well. And so those are typically 2 very powerful ways where people can invest money. But life insurance has somewhere between 10 to 15 different living benefits. It has a tremendous amount of efficiency for each dollar that I put into a permanent life insurance contract. So we won't go through all 12 of them today. We don't have time, but a couple of my favorites we could talk about. First of all, if I get what I want and I live a long time and my term insurance expires, then I can lament the fact that I had opportunity loss with that term insurance. The first is I paid a premium that I got no return on. And if I have $1 million life insurance policy, or I pay maybe $1,000 a year on that, after 20 years, that could be $20,000, $30,000 of opportunity loss that went out the door. That's opportunity cost number 1. Opportunity cost number 2 is all the investment I could have had with that $20,000 or $30,000 that I forewent also because my term in life insurance expired. And third, one of the things that people often don't think about is the generational loss, which is the family will not get that death benefit when the term insurance expires. So when I buy permanent life insurance, one of the first things I do is I'm able to claw back all the opportunity losses that were associated with a term policy. A couple other things I think are really important to talk about is the balance between what I call contractual wealth and statement wealth. Statement wealth is really just how much am I worth when that statement comes out. I have no idea what that wealth is going to be next month, but I know that I'm hoping there's going to be some money on my statement. But in the insurance world, we have contractual wealth. So we know this to be true in the annuity world, right? I know I can't lose money when the markets go down, but in life insurance, we have contractual wealth also, right? We have the cash value that's growing. And if we have certain kinds of policies, that cash value is guaranteed to grow every single year. Perhaps my death benefit's contractually able to grow each year. Perhaps contractually my premium is not going to change over time. And of course, the biggest contract that we have is the fact that I will have that death benefit when the time comes. So beginning to build a balance between statement wealth and contractual wealth brings certain efficiencies to anybody's financial strategies. We also know that life insurance comes with the ability to have a disability waiver to it, where if I become disabled, the premium is going to be able to be paid. So it's a self-completing policy at that point. We know it has long-term care riders on it. So it's very common today for people in their 50s and 60s to think about buying a life insurance policy, not just for the death benefit, but also getting that added benefit of potentially using it for long-term care if they need it, having multiple benefits again for that same dollar. We know that it provides liquidity for estates. Stoyan just gave us a couple options where we can use it for estate equalization. I'll tell you, you don't have to necessarily be worth millions and millions for the estate equalization thing to make sense. We know that sometimes parents just have the ability to maybe a child maybe want the family house and the other two kids don't want the family house. It could be that simple that, all right, you get the house, you get the death benefit, and everybody's even Steven at that point, right? We know it can be used to help offset charitable giving as what Stoyan talked about. And so those are a couple of things. The other part that I wanted to make sure is we understand that we can use it as a private line of credit. So some of the people out there might have heard of infinite banking. Guess what? I'm not necessarily a big proponent of infinite banking, but all policies come with borrowing mechanisms to them, right? So we know that there's, in the time of need, there's the ability to take money out of that policy. Sometimes you can use it as leverage. If you have real estate or other purposes, you might be able to earn better returns than the loan charge is. And then the last couple that I'll talk about really does come from the fifth option of the book, which is when I have a death benefit, when I have a permanent life insurance policy, I gain two additional retirement income choices that are far more powerful than if I don't have the life insurance policy. As we know, most of the people out there will argue that if I'm in a market-based only solution, meaning I just have investments in the market, then I live by the 4% rule. And we know the 4% rule for most people is not that much income compared to the asset base that's required to be able to have that income. But when I have a life insurance policy, two things happen. One is if I have a cash value, maybe 2 to 4 years worth of income, then I don't have to be on that 4% rule anymore, because the 4% rule is really there because I have to navigate the negative years. So if I can use my cash value as a buffering asset, meaning when the markets are negative, I'm not selling into that negative market, then I actually can move into the 5 and 6 and sometimes 7% withdrawal rate at the same level of risk as the 4%. And so what I've done now is I've unlocked the asset base. I've unlocked their spending power because I have a way to navigate the negative markets. Now, some people just don't want to watch CNBC when they're retired, and they'd rather just go travel, not even think about markets going up and down. And they would prefer to buy some sort of perhaps income annuity. And as we all know, that if we live long enough, at some point, the asset base we gave to the insurance company will be gone, even though I get to continue that income stream, whether it's a SPIA or whether it's a fixed index annuity with a rider on it. And so the death benefit then replenishes the asset base that I gave to the insurance company so that my family gets all the money we spent in retirement back in a contractual manner. And as we know, those income annuities can be very powerful in terms of their distribution. So one of the things that we get with life insurance is we can move beyond the 4% rule, closer to that 6, 7, or 8% withdrawal rates, which may double an income, or it may require I only need half my asset base to have the same income flow that I would have had with the 4% rule. So those are some of my favorite living benefits that come with life insurance.
I love that our industry has stopped just talking about life insurance and they call it more of a living benefits policy. And we've really softened the conversation, even though it's a really important conversation. But I'm going to switch gears a little bit because right now, if you get on the TV and you watch any type of news, there's a lot of things going on in the political scene. So, Stoyan, there are a lot of changes going on in Washington. And some people might be feeling insecure about their financial futures where others don't. Can you share how life insurance can be a great supplement to help ease those concerns and create security?
Yes, actually, that's a very good point, and thanks for bringing that up, because the way I look at this is for a very small fee, you can disinherit the IRS and you can take your estate out of everything that's going on in Washington. And whether it's going to be less than 0.5% on a long-term basis on a cash value growth inside of a life insurance policy, which is less than a traditional money management fee, or whether it's going to be taking your estate and just putting less than 1% at certain age groups into a life insurance policy that replenishes all of that estate, regardless of what happens in Washington. Those are some of the opportunities that we should be talking to people about. I keep reminding people, and Ed Slott is a very big voice in that part of the financial planning world, that life insurance is still paid out income tax free. It grows tax deferred, and it can be taken out on a tax free manner, whether it's going to be supplemental retirement income or for a living benefit. One other area that not a lot of people talk about, and I just had a call with a potential prospect who is a surgeon at a local hospital here in St. Louis, and they didn't have any cash value life insurance, but cash value life insurance enjoys creditor protection. And also, in most states, it also enjoys bankruptcy protection too. So those are some of the conversations that we don't talk about and that are need to be brought front and center when you talk to clients. And you all have heard Dave Allison talk about there's only money can go, right? It's a family, charity, or government. And you can basically pick any of those, any two of those three, and you can decide which ones. And life insurance plays a huge role in which ones of those you can pick for your assets and for your hard earned accumulated wealth to go to. Is if you also look at life insurance, and another often overlooked aspect of it in our industry, but not here at C2P, is talking about it from the context of order of money. And so when you have that ability, and Walter alluded to that a little bit earlier today by increasing the probability of success, if you have part of your assets into a life insurance policy that you can take out in retirement, that you can take out cash in retirement, that increases your success. And we have quoted studies by Ernst & Young. We have quoted studies by Morningstar in the past on some of these coffee breaks, that if you have about between 25 and 30% of your assets into a life insurance policy at the time of retirement, that increases your chances of success by almost double. Those are the conversations that we have to have with our clients. And I understand that not everybody is suitable for cash value life insurance policy, but something is always better than nothing. And especially now that we have the Secure Act for the last, 7, 8 years that took out the stretch IRA, life insurance is the great equalizer, as I often keep saying, in that particular aspect.
I love that phrase, the great equalizer. So I'm going to kick it back to Walter. Aside from the desert island dilemma, how do you articulate to your clients the importance of life insurance through storytelling and other strategies? Because if we're going to, as advisors, if we have to open up ourselves to more conversations, how do we do that?
That's a great question. So stories are very powerful, right? I think especially for young people or people who aren't used to selling life insurance, I think being able to present a story, I would say beyond just the kind of classic, I have clients who've passed away and this has helped them or not. I think there's other avenues of stories that could be helpful. One of the things I used to do especially when I was early on with folks, when I work with younger families that aren't sure how much death benefit they really should need, Then I just tell them that, and some of the people may have heard the story, which is just the classic UPS truck story, where if we have a couple sitting together, we take the breadwinner and say, you're backing out of the driveway. And if the UPS van runs over your car and kills you, what are you going to do? And the spouse will say, we got to sue the UPS. And the question then is, how much are you going to sue them for? As much as we can get. There's actually a calculation that the courts do that helps you determine what your husband would have been worth. So we take his income multiplied by the number of years that he has left to work, and that's roughly your human value, economic life value, right? That's typically what someone is worth. And so then we just compare that number to the term insurance that they're applying. And it'll be way off compared to what that is. And we can simply ask the surviving spouse, never ask the spouse that was killed. You always ask the surviving spouse, how much of that death benefit do you think you would want if your husband passed? And it will help move the needle from the classic $1 million that everyone kind of defaults to, when we know that in 3 or 4 years, that $1 million might be consumed, versus maybe that's more like $3, $4, $5 million that's really appropriate for the family protection. So we can help get them out of their mindset of just thinking about death benefit and having kind of a knee-jerk reaction to $1 million sounds like a lot of money. The dirty little secret is you cannot get rich with a death benefit. You are just going to get the money you were going to earn anyway. You're just getting it up front, right? So insurance companies are not giving you the business. They're not in the business of giving you more money than you're worth, right? So it sounds like a large amount of money coming up, but the reality is it is what you would have earned over your lifetime anyway. We're just getting that up front because of the tragedy that may have happened. So that's just one example of a number of stories that we typically use when we sit down with folks.
Stoyan, do you have anything to add? What do you say in this if you're going to open up that conversation? Or is there a story that you?
I typically like to play a game with some clients that don't think that life insurance is valuable in their particular situation. I ask them a very simple question. What would you say is your most valuable asset? And I just shut up and let them say whether it's going to be the house, whether it's going to be their business, whether it's going to be their 401k, whether it's going to be their boat, whatever it is. I listen to what they say, and very few people actually say that the most important asset in their particular situation is their income. Because without your income, any of those other things are not going to be there. And Tom Hagna has a pretty good saying about that. If you die, your wife is going to ask, how much life insurance do we have? And are we going to be able to live comfortably? Are we going to be able to stay in the house? Are the kids going to be able to go to the same schools? So if you don't have that income, all of those other things are not possible. And that's going back to what Walter was saying about how the courts are calculating human value. And I use a very simple formula too. I tell the clients usually, okay, how much money are you earning today? Multiply that time by the number of expected years that you're going to be working. That's basically what an insurance company is going to be looking at you from a human value standpoint. We can fine tune that with a calculator. There are a ton of calculators online that you can use for that. But that's basically it. And then from there, you can decide what your budget is and how you're gonna break that death benefit into manageable chunks, whether it's going to be your laddering term insurance, or whether it's going to be permanent, or whether it's going to be a combination of both. I'm a big proponent of combination of both term insurance and permanent, because there's always a permanent need, and some of the living benefits that we have over the last few years, some of the new kind of life insurance, that's what you can use as when you go through your annual reviews with your clients, or if you take on a new client and you volunteer a policy review, that's what you can say. There's so much innovation in the life insurance policy space that some of the living benefits are quite invaluable. And that's why I like to ladder policies, starting with term insurance, because term insurance covers the immediate need at a very inexpensive cost, and then graduating into retirement, where now your priorities shift to whether you're going to be covering your spouse and or using it as a living benefit.
I love the fact that you mentioned innovation. And as we're wrapping up, I want to ask Walter and Stoyan just a quick question, because we all nerd out on products. Are there any new products out there that you're just excited about that does a better job of fitting a client's need or easier for an advisor to position? Walter, I'll start with you.
I think, yeah, so I'd probably better to answer that because he sees multiple products. But I'm excited about the fact that we have such robust long-term care potential with the death benefit of the policies now, because we know even if you barely love your children, you're going to need some sort of long-term care, right? And I joke with, you may not love your children, but you will love your grandchildren but more, right? So when you get this death benefit, know that it's going to go to a good cause, but potentially, really, you may end up using some of it yourself, right? And so we all know that we're concerned about long-term care. If I can marry that with a death benefit at the end of the day, I think that's a pretty powerful combo.
Stoyan?
And I'll build on to that by saying that, yes, we have seen tremendous innovations in the living benefit space, long-term care, chronic illness. The newest one came out last week from John Hancock. And basically, for those of you that have used SPIAs in the past, a SPIA is basically a bet against an insurance company that you're going to outlive their average mortality bet. And so in this particular case, it's a bet on yourself that you can that you can grow your long-term care benefit actually much higher than any of the other guaranteed products. Another big improvement in what I've seen in the industry lately is around underwriting and underwriting improvements. And companies are making it ever so easy to apply for a life insurance policy and not go through all that extended exam and doing sometimes EKGs and making that process very cumbersome for people to apply. We have seen healthier clients get policies in less than a week using accelerated underwriting techniques, and companies are constantly looking at ways to innovate there. One of also the biggest aspects and improvements has also been the index universal space and some of the new indices that have come out, some of the policy management techniques as well. There's a tremendous amount of innovation happening given where technology is today.
That's fabulous. So Stoyan, Walter, thank you as always for joining us and doing what you do best, is giving us great information. So thank you all for being here. So whatever you do today, make it a great day.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.